Did you know that during the last housing bubble, home prices in some US cities skyrocketed by over 60% in just 5 years? It's a shocking statistic that reveals how quickly the market can shift from stable to explosive. In 2008, when the bubble finally burst, millions lost their homes, and the economy took a massive hit. The truth is, housing bubbles are not just numbers on a chart, they have real consequences for people and communities. So, what causes these bubbles? Why do they happen, and how can you spot them before they pop? In this article, we'll dive deep into the hidden triggers of housing bubbles, uncover the strategies that banks and investors use to inflate prices, and explore how you can protect your investments. Prepare to learn about surprising factors, like how phantom inventory can mislead buyers or how small towns can suddenly become real estate hotspots. You'll discover essential indicators that many overlook, helping you become a smarter investor. Join us as we unravel the complex world of the housing market and equip you with the knowledge to navigate its twists and turns. By the end of this journey, you'll be ready to identify bubbles and make informed decisions, whether you're buying your first home or investing in real estate. Let's get started. Chapter 1. The Hidden Triggers. Seeds of the housing bubble. Most people think housing bubbles start with too many buyers and not enough homes. But the real causes go much deeper. One key factor is phantom inventory. This is when banks hold foreclosed properties off the market, creating an illusion of low supply. According to a 2015 report by RealtyTrack, banks held back nearly 30% of foreclosures from the market after the 2008 crisis. By limiting supply, they propped up prices artificially. Another hidden trigger? Inflation creep. When inflation rises, everything becomes more expensive, from building materials to land. Between 2020 and 2021, lumber prices alone rose by over 300%, pushing up the cost of new homes. Value investors can use this knowledge as a signal. If material prices are surging while wages stagnate, a bubble may be brewing. Demand-side triggers matter too. Low interest rates fuel buying frenzies, but they're often coupled with easy money policies. These policies encourage banks to lend more. In 2020, the Federal Reserve lowered interest rates to near zero, sparking one of the hottest housing markets in decades. As Warren Buffett famously said, "Only when the tide goes out do you discover who's been swimming naked." When rates rise, many buyers can't afford their homes, and prices start to drop. For value investors, tracking interest rate changes can be an early warning sign. Chapter 2. The Banker's Game Plan. Leveraging loans for profit. Banks and lenders play a huge role in inflating housing bubbles. They don't just loan money, they structure those loans to maximize their profits. Take mortgage churn as an example. This is when banks encourage homeowners to refinance their mortgages multiple times. They make money each time someone refinances, and homeowners end up with even more debt. In 2021, Americans refinanced their mortgages at record rates, spurred by historically low interest rates. Then, there's creative lending. Some banks offer low down payments or interest-only loans, which initially make homeownership cheaper. But these loans often have a catch. When rates reset, payments jump, and many homeowners can no longer afford them. In 2005, interest-only loans made up 25% of all mortgages in the US. When rates increased, these loans contributed heavily to the 2008 crash. For investors, these loan types are a red flag. When banks start pushing creative financing, it's often a sign they're priming the market for short-term profits, not long-term stability. Banks also rely on loan securitization to transfer risk. They bundle mortgages into securities and sell them to investors. This process, called mortgage-backed securities, made headlines during the 2008 crisis. Essentially, it allows banks to offload risky loans while keeping profits. According to Michael Lewis in The Big Short, the incentives on Wall Street were all wrong, they rewarded bad behavior. If you see an increase in mortgage-backed securities in the market, take it as a caution. It means banks are playing a high-risk game and looking to offload bad loans. Value investors can learn a lot by studying these patterns. When banks start churning loans, pushing risky financing, and securitizing mortgages, it's often a sign of a bubble. Being aware of these lending tactics can help you step back when the market looks too hot. Chapter 3. The Investor's Playground. fueling speculative frenzies. Speculators and institutional investors also play a big role in housing bubbles. They buy up properties, expecting prices to rise, and often do so in large batches. This practice is called block buying, where big companies purchase multiple homes in a single area, driving up prices. According to data from CoreLogic, investor purchases made up 16% of all home sales in 2021, the highest in 2 decades. When big investors dive into a market, they create a perception of scarcity, even if the actual demand is steady. Another tactic they use is renovation arbitrage. This involves buying older homes, renovating them minimally, and then flipping them for a much higher price. A Zillow study showed that in hot markets, renovated homes sold for up to 40% more than their purchase price. Value investors should watch for rapid spikes in home improvement spending in specific markets. When big money starts pouring in for quick flips, it's a classic sign that the market is overheating. Speculative buyers also rely on a strategy called rental yield compression. When housing prices soar, rental yields, the income from renting a property, often don't keep up. This happened in major cities like San Francisco and New York, where housing prices skyrocketed, but rental returns didn't. Value investors should calculate rental yields in hot markets. If property prices keep rising but rental income stagnates, that's often a signal that the bubble is about to pop. In the words of Howard Marks, the safest and most potentially profitable thing is to buy when no one else will. If you see major investors flooding a market, consider whether it might be wiser to look elsewhere. Chasing the hottest trend often leads to buying at the top, right before the bubble bursts. Chapter 4. The domino effect. When small towns become big deals, bubbles don't just affect big cities, they can spread to smaller towns, creating a domino effect. When urban areas become too expensive, many people start looking for homes in the suburbs or smaller cities. This is known as spillover inflation. According to a 2021 report from the National Association of Realtors, areas like Boise, Idaho, and Austin, Texas, saw home prices jump by more than 30% as city dwellers migrated in search of affordability. For investors, this trend can be a double-edged sword. On one hand, it creates new opportunities in emerging markets. But on the other hand, it can signal that a bubble is forming in those areas as well. Tracking migration patterns can provide valuable insight. If you see a significant influx of residents to a smaller town, it might be time to act before prices spike even higher. One unique factor in smaller markets is the local economic anchor. This refers to large employers or universities that drive demand for housing. For example, cities with major universities often see a consistent influx of renters and buyers. A study by the Federal Reserve Bank of Dallas found that areas with a strong educational presence experience 15% higher price stability compared to others. If you notice a town gaining a new employer or educational institution, consider it a potential hotspot for investment. But remember, just because a market is growing doesn't mean it's a wise investment. As economist Robert Shiller notes in Irrational Exuberance, markets can remain irrational longer than you can remain solvent. Always weigh the potential for growth against the risk of a bubble. Chapter 5. The overlooked indicators. Spotting the cracks in the bubble. Now that we understand how bubbles can spread, let's focus on how to spot when they are about to burst. Many investors overlook critical indicators that signal a market's peak. One key metric to watch is the rental yield gap. This measures the difference between home prices and rental rates. If home prices are rising much faster than rents, it could indicate a bubble. In 2021, the average rental yield in major cities dropped below 3%, the lowest in years, while home prices soared. Another important sign is buyer sentiment cooling. When buyers feel anxious about overpaying, it often leads to a slowdown in sales. A survey by Fannie Mae found that as home prices rose, buyer confidence dropped by 30% in 2022. If you see a shift in consumer sentiment, it's wise to reassess your investment strategy. Also, keep an eye on foreclosure rates. A rising number of foreclosures is often a precursor to a market correction. According to CoreLogic, foreclosure rates increased by 40% from 2021 to 2022, signaling potential trouble ahead. Investors should monitor these rates closely, as they can indicate financial strain among homeowners. Lastly, pay attention to local economic indicators, such as unemployment rates and wage growth. If job losses begin to mount, it's a strong indicator that the housing market may soon follow. As market analyst Peter Lynch wisely said, "Know what you own, and know why you own it." Always stay informed about the broader economic conditions in the markets you invest in. If you found this information valuable, consider subscribing to our channel for more insights on value investing in real estate trends. Stay informed, stay ahead, and keep building your wealth.